All right. So we will begin by going through the practice test. This is more for the recording for our 3 that are gone. Then I'll go through problem B just to show you the answers. If you want some clarification on things, we can. I can talk and field questions, or you can just have study time, whatever you want to do. Test will be tomorrow, Friday. I'm going to send home with you Chapter 11 handouts, workbook stuff. You will need to read and take notes over the weekend on Chapter 11, so we can just push into the week because it's going to be another 2-week chapter. And I'm going to be gone 3 of those days. You guys will be gone a week from today for your senior mentorship presentations. So another 2-week chapter where we're going to have interruptions. When the days I'm gone but you're here, I'll have lectures for the sub to show. And then the beauty of those is you can hit pause on me if you're sick of listening to me. So here we go. Chapter 10 practice test. Number 1 is false. You really just need to know the L, the LI, the, oh my goodness, I forgot the other ones. Land improvement buildings, or what's the 4th one? Maybe none. Equipment, thank you. And none, or other, or X. To get the land ready to clear, drain, fill, and grade is not a land improvement. Land improvements would be more of like the shorter lifespan, the shrubs, the parking lot, the fence, all that. Number 2 is true. The balance sheet account affected is what's called accumulated depreciation, which is a contra asset. The income statement account is usually what's called depreciation expense, or depletion expense, or amortization expense. It's an expense. Number 4 is false. Depreciable cost of a plant asset is its cost minus its what? Salvage value, instead of having it become obsolete. Number 4 is true. Number 5 is true. Why is depreciable cost not factored into double declining? What do we use instead? The cost, and then you'll have a book value at the end that transfers down to the next year. Number 6 is true. That was a tough one because I had you depreciate out all full years, but you saw where it started losing value and you'd still just keep using it. Number 7 is hard because we didn't talk much about this. It's false. The only way you're going to remove it from the books is if you sell, dispose, or retire it. So that was the little section I kind of skipped over. I just talked about selling, disposing, retiring. That's really the only way you get rid of an asset off the books, is if you physically don't have it anymore. Number 8 is true. The accumulated depletion relates to natural resources. Number 9 is true. Now number 10, what did you guys put? I'm just curious. The answer is false, but it could be true. The word must is a little bit constraining. We're talking patents, right? Yes. Patents have up to 20 years of useful life, but if it might be an 8-year patent, so whatever's shorter. Just associate 20 with patents, though. On that one, the answer technically is false, but you could argue it's true because of the 20 years. 20 years or less. So when it must be amortized over 20 years, that's actually false because it's 20 years or the useful life, whatever, is shorter. But I want you to memorize that patents are 20 years. Hi, Riley. Next page. The cost of a purchased building includes all except D. They're all included. Closing costs, paying a realtor, remodeling costs. 12 is also D. They bought land for $90,000, got to pay the realtor $5,000, and $7,000 was spent on demoing an old building. It's valued at $102,000. 13 is also D. Paving, lights, those are all what are called land improvements. 14 is D, and so is 15. 14 is D because as you expense out every year, you're throwing it over to the accumulated depreciation pile. If it's straight line, it's going to be the same little stuff you throw over to the pile. If it's double declining, it's going to be a lot at the front end and plateau off. If it's units, it's going to really depend on how many units, miles, hours you put on that machine. But the amount charged to the expense, so every year we expense it out, we throw that over into our accumulated depreciation pile. When is the only time the expense in the accumulated depreciation pile will be the same? In year one, because we're throwing something to the pile for the first time. Like I said, 15 is also D. The book value of an asset is cost minus the accumulated depreciation. That's book value. Depreciable cost is cost minus what? Yes. Salvage value. 16 is C. You first got to figure out the straight line rate. We take 100% divided by, what does 5 mean? Useful life for years, so 20%. Double declining would just be double that, so 40%. Which depreciation method is most frequently used in business today? The answer is A. But to be honest, it really depends on the asset. I don't love that question. It really depends on the asset. Lawnmowers are not a straight line depreciation, in Minnesota anyway. Maybe in Arizona they are. I take that back. Most of them have like rocks for lawns, right? So it just depends. Your cars you drive, especially in Minnesota, double declining easily. Okay, so I don't love that question, but they're saying just in general people are using straight line. I don't know about that. Depletion is related to natural resources. C. Couple more on the next page, right? Do yours go on to the next page too? Okay. Amortization cannot exceed, on a patent that is, 20 years. I like that question better versus what we saw on the true-false. 20, units of activity is an appropriate depreciation method on C when they vary from year to year significantly. School buses would be a great example there. Anything that's used not 12 months out of the year. I want to stop there. What questions do you guys have before we get into the next section? Memorize the chunks of the chapter. L, LI, equipment. I forgot that other one again. Buildings, B, or X, none of the above. The big one there is if it's a recurring cost like gasoline, that's an expense. That's not any of them. If it's putting tabs on it, that's an expense. That's doing it every year. The hard one is property taxes. If it looks like it's happening every year, that's an expense. Anytime you build or buy land or a building, you have to get the property taxes updated at the time of purchase. And so then that would be land or building, depending on what you're buying. So if it's like paid the proper or accrued property taxes at the time of the purchase of building or land, then it would get plugged into those versus the ongoing property expenses year after year. All right, let's go to this number 21. I got a little ahead of myself there, but let's see here. Number 1 is LI. Number 2, why is that X? Why is it none of them? Yep, monthly electrical bills. Yep, they're recurring. What did you put for number 3? I'm just curious. Land. Do I have any buildings out there? Do I have any LIs out there? Could you argue all 3 of them? Excavating to get the land ready to do what it's supposed to do. Excavating to build a building ready to do what it's doing. You even got to sometimes excavate to put like a parking lot or a fence in. I would accept any of those answers. It's one of those gray areas. Now, had they put like excavation costs to get the land ready for its intended use, then it would definitely be land. But they kept it kind of gray there. Interest on a building construction loan. B. Cost of trial runs for machinery. E. Drainage costs. I really could argue L or LI on that one. You have to have certain things, you have to have certain drainage for parking lots. There's a name for it. My highway making husband would know. Oh, I should know this. I'm sorry. You know, like when you go to big box stores, like let's just use a Walmart. You know, it always looks like there's a pond somewhere at Walmart. That's what that means. It's like runoff drainage from that parking lot. You guys know what I'm talking about? Yeah, that's what that means. So I'd say land or land improvement on that one. Cost to install a machine. E. Fences. Are they going to last forever? LI. Oh boy. Unpaid past property taxes assumed. That could either be land or building, like whatever you're buying. That gets rolled in. Now, had it said property taxes for the next 3 years, then that would have been X. Cost of tearing down a building when land and a building on it are purchased. Land. Sheesh. Okay. Next one, 22. I like this one. I think this is good. Tell me if it's amortized, depreciated, or depleted, or none of them. Goodwill. None. Explain to me what goodwill means. Why is that an asset that you own? It's a weird one. The best example we can give is when Superior bought out Hancock Concrete. You're getting that goodness that comes with it, and its placement, and its people, and all of that. But it doesn't lose value. It will not amortize. Land. None. Land does not depreciate, according to this chapter. Buildings. Depreciate. Patents. Why can we safely put A there for amortize? They have a limit. What is the limit? 20 years or less. Yeah. Copyrights. Do they amortize? As of now, they do. I think we will see this in the news. It's the Mickey Mouse one. Okay. Who owns Mickey Mouse? Walt Disney. He died, and it's nearing the 70 years beyond his death. So that will be in the news because Mickey Mouse is worth $3 billion. R&D. R&D costs, research and development costs. None of them. They are an expense. They're an expense of doing business just like having the lights on to make improvements enough to that patent so they can re-up the patent for another 20 years. Timberlands, in other words, trees. Deplete. Franchises with an indefinite life. None. Licenses with a limited life. They amortize. Land improvements. Depreciate. Oil deposits. Deplete. Equipment. Depreciates. Do you feel like that's easy? You gotta just study it. It's 10 points. Like on a 100-point test, that's quite a bit. So you'll see that tomorrow. Asset turnover. 2.5 times. It's a really, really, really good asset turnover, isn't it? So far, we've seen cents. And what that means is for every $1 of assets, it's yielding $2.50 in revenue. They're doing well. Okay. The transaction to get, or excuse me, the math equation to get it, it's net sales divided by average AR, which we know is beginning AR plus ending AR divided by 2. So it's 2.5 million divided by 800,000 and 200, well, 1.2 million divided by 2. The next one was hard. I'll be honest. You wouldn't see something as hard as what we're about to do on the test. There were some terms that even that I'm like, what? Like, what is HMACRS? I don't. So let's just rip through them. Number 1 is I. I put a question mark by that. I don't even remember talking about that one. Number 2 is C. Remember, cost minus accumulated depreciation is book value. Cost minus salvage value is depreciable cost. Number 3 is G. Number 4 is A. Number 5 is E. Number 6 is D. Number 7 is B. Number 8 is J. I don't know. I don't remember ever talking about capital expenditure, but I definitely remember talking about like things to keep your assets going and training and all of that. Number 8, I had a question mark but it's H. And then F is number 10. Some of them were good. They're good study materials, but. So this next one, you can tell like what we did with our mid-chapter work was more detailed, but didn't this almost seem simple? I mean, like my answers look just really, there's not much math there. Do you want me to write them out or should we just talk about them?
I have a question.
Yeah.
Like, did you want us to provide them or did you want like each?
They wanted them combined, like you did it right.
Okay.
Yeah. Like I'm not going to write them all out, but I'll just look at car 1 here, all the way down. So car 1, for A, they wanted us to determine the depreciation rates. So I did depreciable cost divided by miles. So in this case, it was 21,000 minus 3,000 divided by 75,000. It's going to depreciate 24 cents a mile. If you did it the long way, that's okay. Car 2 was 26 cents a mile. Car 3 was 30 cents a mile. No matter what way you did it, I'm just like, did you get those answers, hopefully? Okay. You then take the answers from part A and use them for part B. Oh, Microsoft Word, you just don't want to play nice. Here we go. Okay. So then in part B, I'll just still do car 1. Actual miles driven were 20,000 times the 24 cents a mile, $4,800 in depreciation. Number 2 is 5,720. Number 3 is 5,700. So it felt kind of easy. The last one, make one compound entry. So just the way they state it, like they don't want it to be expense, accumulated depreciation, expense, accumulated depreciation. They want you to all lump it into one. So they're just saying on all 3 vehicles, what would be the annual expense for the fleet? So depreciation expense. I'll leave that debit for just a minute. Accumulated depreciation. Car 1, car 2, car 3. They want you to lump them all together. So then that's where you pull your 48, your 5720, and 5,000 for the one debit of 16,220. Now, if you did them each separate, like you did one for car 1, one for car 2, one for car 3, technically that would be wrong because they asked for a compound entry, but I'm not ruthless either. You know what I mean? Like, and you can tell this was all focused on units of activity. Again, depreciable cost is the big one there. Okay, let's do the next one. The next one's got a machine, and they want you to look at the annual depreciation for the first and second year using straight line and then double declining. So let's look at straight line first. $15,000 a year. So we figure that out by taking 100% divided by its 5 years. So straight line is 20%. %40 is double declining. Cool. Straight line. Do we just roll right into the $80,000 machine, or what do we have to do? We need the depreciable cost. So cost minus salvage value. In this case, it's $80,000 minus $5,000. So year 1, year 2, we'll start at 75,000 times 20%. Next year, 75,000 times 20%, 15 grand a year. What would the accumulated depreciation pile be up to at this point? If they were asking us that, they're not. They're just asking us for the annual depreciation. So every year, the expense. What would the pile be up to? 30 grand. Because it's 15 plus nothing is 15. The next year is going to be 15,000 again. 15,000 plus another 15, so now our pile's up to 30. They weren't asking for that, but I just thought I'd remind you. If you like to do it the long way, like what we have been doing, totally fine. So when we do double declining, are we looking at depreciable cost? No. We are looking for what's its book value. Well, on year 1, it's 80 grand. This time we're going to take it times 40%. So what's it sitting at after year 1? 32,000. What are we going to start year 2 at? Because we have to take 80 minus 32 to be the 48,000. We bring that amount to start the next year. We take that times the 40% again, 19,200. So that's each year. Our accumulated depreciation pile has grown to 51,200. What can I answer on that? That's it, you guys. Feel okay? Do you like 2-week chapters better? Our 2-week chapter, I miss seeing you 3 times though, right? 3 or 2? No. 2 at least. So I will go through the B set with you. I don't even have my book in front of me, but here's the B. Answers. I would love for someone to explain property tax versus ongoing as an expense versus property tax at the time of a purchase. Who can explain the difference? Good. You got it. I would assume my answer key looks way different than yours, but can you get at the numbers anyway? Okay. I like our way better than the book's way. Would you agree? It like tells the story better. So machine 1 we must have bought on January 1st, 2011. Machine 2 we must have bought in 2012, and machine 3, 2014. So they wanted you to only go through 14. I think our way tells the story better, but I hope these gave you the answers you needed. Okay, then B, what if we bought the machine on 8 of 12? We must have bought it on May 1st. So what would it look like if we bought it on May 1st instead? So you used it all of July, August, September, October, November, December. No, that must not have been June. What month did we buy it if we owned it 8? May, okay. I believe we skipped this one. We did not do 10-3. When you get rid of assets, it's the only time you take them off the book. You either sell them, you throw them away, or you trade them or exchange them. What was our next one? 6? 8. Look at how much you guys got to skip. Okay. I wouldn't get so worried about the journal entries here. I just really, really, really want you to know what depreciates, what depletes, what amortizes, what doesn't. That's really what I want you to know. And you must have done 9. Our corp is doing well. Anytime you're over $1, that means like your assets are making that much money. Like the one that we just did from the practice test, if you have $1 worth of assets and they're making $2.50 in revenue, that's really good. Really, really good. So that really concludes our work. I'll hit stop in the recording.